Dear friends, welcome to Shasha's virtual classroom. So, we will discuss accounting for Cambridge IGCSE and O level course book, Catherine Gucom, Alistair Mackenzie. So, this is third edition. So, particularly in these sessions, we will discuss activity solutions. So, these are the contents. First section, introduction to accounting, double entry bookkeeping, the trial balance, double entry bookkeeping, part B, petty cash books, practice questions. So this is the book you have as a hard copy with you. So if you don't have, please get it. Okay, so this is activity 1.2. So we'll discuss this, but before this we need to know certain things. So before attempting this question, we will discuss certain things which are very important for this. So these are the topics which have been discussed in this lesson, that is introduction to accounting, bookkeeping versus accounting, why measure, why do you measure profit and loss, profit or something, whatever. So what do you mean by assets, liabilities, capital, what is accounting equation, what is trade receivables, what is trade payables, what is inventory, what is asset statement, what is statement of financial position, all these things. So first thing, what is bookkeeping? So we'll have just a brief overview. So what is bookkeeping? Bookkeeping is primarily recording business transactions in detail. That's all, nothing else. Okay, recording all the business transactions in detail. Who does it? Obviously, the person who has sufficient evidence regarding the business transactions entered will maintain books. So that is known as bookkeeping. So what is accounting? Accounting is something which starts after bookkeeping has been done. So accounting means basically compiling, reporting, all those things, which is done after bookkeeping. So this is the secondary. So this is primary aspect, this is secondary. So in accounting we take the sources from bookkeeping and we prepare statement of profit, statement of profit or loss, and statement of financial position, all those things and all we prepare. So basically that is also, you can refer the textbook for all this in detail. Just this is just a brief overview. So then next, why do we measure profit and loss? Why? Measure. So basically when anyone starts a business, basically he should know how much of profit has been done, what is the status, where is he standing, how much of earnings he has made, and how much he has kept it with him. So all those things he has to know. So that is why we need to measure. Otherwise this is the, if you are not capable of measuring, then it is not worth considering continuation of the business at all. So and if any changes have to be made, what any improvements have to be made, all those things are based on the financial statements. Like without measuring what is the profit or loss or whatever, so we will not be able to decide. This is to decide and to motivate yourself or to get a more upgradation or more knowledge from whatever has been done. So then next one, next aspect is assets, liabilities and capital. What is assets? See, let us say Mr. David, okay, Mr. David, he has got he stays at two places. Let us say he stays in New York and he stays in Los Angeles, okay. Let us say he stays in New York, and he is, so there in New York he has got a land worth 1 million, so he has got a building worth 2 million. So okay, so Los Angeles also he has got land worth 2 million. So building also he has got worth 5 million. Now he is interested in starting a business. By name Hopkins Inc. He starts a business by name Hopkins Inc. So what he will do? He has started. He wants to start business in New York. Let us say he starts in New York. So he will use his land and his building for the purpose. This land and this building for the purpose. So these are, when he starts his business, these are known as business assets. So what do you mean by asset? Asset is something which he has. Okay. Something which Mr. David has. Business assets are those assets which he has used, which has introduced in business. Similarly, Los Angeles, whatever he has, that is his personal residence. So personal residence. So these are his personal assets. Okay. So these are personal assets. Now, what do you mean by asset? Asset is something which a person has. And business assets are those which he introduces in business to start the business, to run the business, to use in the business. He has started with this land and building so that he will do the business from here. So now there is something known as business entity concept. What is business entity concept? According to this business entity concept, land worth 1 million, building worth 2 million are the assets of Hopkins Inc. These are the assets of Hopkins Inc. Land which Mr. David has introduced. Mr. David has introduced land and building. So he has invested how much? He has invested 3 million. Into the business. He has introduced 3 million into the business. What does the business entity concept say? According to the business entity concept, whatever is invested by Mr. David is his capital, and that is 3 million. Hopkins Inc. has assets that is land and building, which Mr. David has given to the business, and the business has to pay back to David. Business has to pay back to David. Mr. David, business has to pay back to David. So this is how it is. So now assets are equal to liabilities. What is liability? Liability is something which the business owes back. Liability is something which the business owes. Liability is something business owes. Business owes. Suppose David has taken loan from Citibank. He has taken loan from Citibank. So how much he has taken loan? Let us say he has taken 1 million worth of. So if he has taken loan, bank money is there in bank. Who has given it? Citibank has given it. So David has to pay back Citibank. So he has got bank balance of 1 million, and David has to pay back 1 million to Citibank. So assets are equal to liabilities. So he has to pay back. He owes. It is an obligation. He has to pay back. Citibank loan. Very simple concept, but few students don't get this. There is some confusion. So very simple concept. So that is what it is. Simple thing. That's all. So what is capital? Capital is the amount that the owner has invested in the business. Assets is something which the business owner has introduced in the business for use in the business. And capital is a liability which the business owes back to the owner of the business. So we have understood what are assets, what are liabilities, what is capital. Okay, next. Equation. So there is something known as equation, that is accounting equation. Here we have seen that the assets are equal to liabilities. And liabilities can be internal, external, internal, external. So what is internal liability? Internal liability is nothing but capital. Business has to pay back to whom? But owner itself. What is external liability? Bank loan. Business has to pay back to an outsider, external. So external liabilities are known as, specifically known as liabilities. Internal liability is known as capital. Simple. That's all. So assets is equal to capital plus liabilities. So what does this concept say? The concept says when something comes in, someone has given it. When something comes in, someone has given it. Something is in. When something comes in, someone has given it. Either when something comes in, someone has given it. Either this or this. Either the owner has given it or some other person has given it. So always there is a double entry. So when something is coming in, something else will go out. When something comes down, some other thing may come down. Okay. So very important. So this is known as accounting equation. So accounting equation, assets is equal to capital plus liabilities. Next, trade receivables and trade payables. What do you mean by trade receivables? See, when we sell goods, so what do you mean by goods or merchandise? What is merchandise? Merchandise is nothing but items the business deals in. So for example, furniture business. For furniture business, if a person is doing furniture business, chairs, tables, all these are goods for him, merchandise. So he will buy to sell. Buy to sell. So when you sell, you may sell them on credit also. On credit. So what do you mean by on credit? There may be an agreement that the person to whom you are selling, his customer or credit customer, who has agreed to pay at a later date. So you write down, you have a record of all this. So which customer will be paying you later on. So that is known as accounts receivable. So the money that is receivable, the amount that is receivable is known as accounts receivable. Means you are supposed to receive money that is a credit customer. So they are also known as debtors. DEBTORS, debtors. We read them as debtors or debtors, whatever. So now accounts payable. So similarly, we may buy goods. The business may buy goods on credit. From whom we buy? We buy from suppliers. On credit. On terms and conditions that we will pay him later on. We will pay him later on. We will pay him later on. Supplier supplies on credit. So credit supplier. credit supplier is nothing but it is called accounts payable credit supplier. So we call them as creditors. Creditors. Accounts payable creditors. Okay. Next. So inventory. What do you mean by inventory? Stock of goods. Stock of goods lying idle. Stock of goods lying idle is known as inventory. So there should be only stock of goods. Okay. So what is the difference between inventory and assets? Even inventories are also assets, but inventories are meant for resale. Assets are not meant for resale. They are meant for use in the business. Assets. Okay, inventories are also assets. Obviously, assets are something we have, but we have kept them with what? With the intention of reselling them. But assets, we have kept them with the intention of using in the business. We are not going to sell them. Okay. Then, statement of financial position. So what happens is statement of financial position means on a particular date, we may record what are the assets with us. So land we have, let us say land we have worth 1 million. Building we have worth 2 million. So these are known as assets. So this is 3 lakhs, 300,000. 3 million, sorry, not 300,000, 3 million. Similarly, liabilities are, that is capital is capital is 3 million. So capital